didn't even see you there. Hey, did you know that the builders in the bear market are some of the best protocols that you can look for the next bull run? In fact, have you heard the popular saying, bull markets can make you money, but bear markets can make you life-changing money? This statement is actually true. There are several different characteristics and points that I look for in each project to determine if the token has staying power and can make it through the bear. We're going to be talking about one of the leading DEXs in the DeFi market. These guys are creating one of the most cost-effective ways to swap between two like assets. In today's KuCoin DigiDive, we're going to be talking about CRV Finance and the CRV token. If you guys would like to get started trading this coin, there's a link in the description below that will give you 20% off trading fees. If you guys haven't already subscribed to the channel, make sure you guys subscribe to the KuCoin YouTube channel. That way you guys are staying up to date in the crypto markets. The quickest way to understand how CRV works is actually going on their main website. When you go on their main website, you can quickly see that this is an exchange that allows you to swap one token for another coin. This would be called a decentralized exchange because it's built on the blockchain. And when you're browsing on the CRV site, you can see that there are different tokens that are listed on here. It's not like Uniswap though. It doesn't allow a swap between infinite amounts of tokens. In fact, it's only between the different CRV pools that they have listed. Being that CRV Finance is a decentralized exchange, anyone in any project can list their own CRV pool. And this is where the CRV token comes into play. I'll get into that later in this video to explain how this works, but as you can see here, you have different pools that anyone can create. Like the Frax USDC pool, I'm sure this was created by Frax Finance, which is a protocol in DeFi. You even have the Convex ETH pool, which is created by Convex. You even have the ST-ETH, which was created by Lido Finance. These are all kinds of different protocols that are taking advantage of CRV's network effect and DEX capabilities. Also, one other thing you can note about CRV is that they're on multiple chains. As you can see here, these are the list of the different chains they have, as well as a bunch of different stats they have for all of the different pools. You can see here, this is the daily APY, so if you want to see how it's going. You can also see a bunch of the other generic pools that they have listed on their exchange that are going to be listed under the CRV daily stats. Okay, Drake, that's great and all. We had a great intro to the website, but that's not what I'm here for. I could have done that myself. I want to learn more about the project and can they still build in the bear? Well, the first question we need to ask ourselves is, how is the growth? One of my favorite websites to use is DeFi Llama. DeFi Llama has a great overview of the stats on CRV and for other DeFi projects in general. It's always important to not only look at it in US dollar terms, because this is DeFi and most of the cryptocurrencies are down by a lot. You need to look at it in ETH terms. How is it doing? You can see that this chart has a steady trend upwards, which is a good sign. This usually means that more TVL is coming into the protocol. And as you can see here, it has about $5.18 billion locked. Now, to understand what this looks like in perspective of a protocol that's not doing as well would be to Solidly. This one is built on Phantom. As you can see here, they did an extremely good job and their TVL has just fallen off a cliff. Now, I'll give them the benefit of the doubt. Let's look in the Phantom price terms. Well, it's the same scenario there. It's not saying they're dead, it's just saying it's not alive. Another website that you can use in addition to DeFi Llama is Dune Analytics. These sites create really good metrics and details on the project in particular. Now, there is one additional site that revolves around CRV, Convex, and the bribes situation. This is called Llama Air Force. It is kind of a weird name, but it does its thing. You can see here on each of the different pools, they actually list the amount of CRV emissions that have been going to it over time. So you have the amount of CRV emissions, as well as in the yellow, this is the percentage of the swap fees from each of the swaps. Obviously, the more swap fees, the better, because with the CRV token holders, they get 50% of the fees, where the liquidity providers get the other 50%. So you can scroll through and see all these different pools and see how it's rolling. Now, the second question you need to ask yourself is the team building and how is the community? You want to be able to go to Twitter, Telegram, Discord, if they have those, and asking a question after you researched that you didn't really understand. If they can't really explain it to you, or they're just saying, oh, you're creating FUD, well, then there's a problem. Of course, you're going to have some of those community members that are just goofballs and just play around a bit. But if you don't have an active community, and if you don't have people understanding what they're actually holding, and they're just holding it for the money, what happens when the money goes away? You want to have a community that's there for the community. Just something to keep in mind. Now, for checking the team, there's actually a pretty cool website called Stack Money. Stack.money, and you can type in Curve or any of the protocols that you're looking for. So as you can see here, if you go to Curve, it pulls up and you can see some information on it. If you scroll all the way down to the bottom, or at least section 3, you can see this is the developer activity. This is a good sign. You want to see developer activity from active developers. Now, to show you an example of one that's not so active, just so you can understand the difference. This would be an example of a protocol that has no developer activity. In fact, it literally just dropped off a cliff after November 2021. There has been no activity on this. So basically, the team hasn't been building on this project for over a year now. So this basically shows me that the team isn't active at all with this. Now, the third question you need to ask yourself is, would you still use the protocol if you weren't being paid to use it, or if there were no liquidity mining incentives? Well, actually, the Curve token is integral to the Curve finance platform. And let me go ahead and explain it to you with a couple of different dashboards. The first one is this. This is the Curve gauges. In order to get different interest rates on the pools that you're deposited in, you have to vote on these pools. And this is the current voting weight. So if a protocol owns 25% of the Curve emissions, that means they will get 25% of all of the emissions. So if it's $1 million that month, that protocol is going to get $250,000 in Curve tokens. And these gauges have an effect on what the APRs are. So of course you have the general swap APR, that's whatever, that's just there. But then you have the additional incentives from the Curve token. The Curve token is actually being emitted to any of the pools that get additional votes. So let's say, for example, my protocol is Frax Finance, and I want to get more liquidity for my Frax stablecoin. Well, I have a couple of options. First, I can create my own LP pool and emit my own governance token and pay people to provide liquidity. Or I can say, I'm willing to pay $1,000 for every 1% of the Curve vote share that is voted to my gauge. And once that happens, then the APRs on my gauge actually go up. And when the APRs go up, people are interested in providing liquidity there because they can farm rewards. So when this happens, this attracts liquidity. Now, when liquidity comes, this also attracts traders because it brings better prices. Now, when you attract traders, that brings in more fees to the protocol. Remember, 50% of the fees go to Curve DAO token holders, and 50% of the fees go to liquidity providers. So you have this flywheel that comes in, to whereas liquidity attracts traders, and then traders attract more liquidity. And the Curve token basically aligns the incentives of everyone. That way people are providing liquidity as well as getting the Curve token and throwing it back into the system in order to earn more rewards. So now another thing you can ask yourself is, when you go to these different Curve gauges, the base APR that you see, is it something that you would be okay depositing in? Would you be okay with a 4.65% on your ETH, especially in a bear market? That's for you to decide. So far, we showed you how to check the growth of Curve. We showed you if the team is still building, how to check the community. We gave you a brief overview of the protocol, and we showed you guys some of the token's utility. But what are the tokenomics of this Curve token? As you can see here, the total supply of the Curve token is 3.03 billion. 43% of the initial supply was distributed, with 30% to shareholders, 3% to employees, 5% to the community reserve, and 5% to pre-Curve liquidity providers with a 1-year vesting. This is for the early adopters. So here's what the release schedule looks like. around May 14th, 2026, there will be about 2.3 billion tokens in circulation. So there is still a bit of runway to go with this curve token. And remember, as time goes on, people keep relocking them into the gauges. The average lock time for the curve token is 3.62 years. So basically you can call it 4 years. And most people are locking their curve tokens. And the last two things you want to ask yourself is, what is the protocol's staying power? And what is its moat? Would I be better off just using Uniswap? Would I be better off using SushiSwap? But as you can see, like earlier in this video, liquidity attracts traders and traders attracts liquidity. And that's mainly why you see the steady growth on DeFi Llama. Because as the liquidity grows, your swaps are automatically going to be less and more cost effective. The reason being is that the pools are deeper. So as the pools get deeper liquidity, they are actually able to attract more traders because they give better rates. And then when more traders come, this also brings more liquidity because the traders are spending a lot of fees. So right now it has a strong staying power and it has a strong moat due to the liquidity attracts traders and traders attract liquidity. And it has this reflexive flywheel that keeps spinning. What are the risks? Well, you have the risk of another protocol that gains a larger market share and captures a larger amount of liquidity. This can be done through token incentives. This can be done through lower swap fees. There's many different things that can be done in order to do this. I'm not saying it's easy, but I'm saying that there is always that chance. Second, you run the risk of the curve token being unlocked, as in people not relocking it to keep playing the game. If a big player stops playing the game, then you run into the issue of less demand for the curve token. And when the curve token goes down in price, the APRs are lower. And when the APRs are lower, that also causes people to say, do I really want to stay in this pool for this amount of APR? Sometimes yes, sometimes no. And if it's a no, they go. When they go, it's lower liquidity. And then you have less traders because it's not as good of prices. So making sure the token is pretty decentralized is important to do. If you go on Etherscan, you can actually see a percentage of curve token holders. Now bear in mind, not all of these are individual wallet addresses. If you look, you can see some of these are actually contracts, so these are a little bit different. Like the voting escrow is entirely different. This is all the people staking and voting. This is not one individual holder. Having a token that's more decentralized actually decreases that risk of a bigger player just dropping out. For Curve in particular, you also run the risk of a big protocol becoming much bigger. And what I mean by this is as they hold a larger market share, they're able to own most of the votes. And when they own most of the votes, they can direct most of the emissions their way, which over time will make the Curve token more centralized to that player because they're able to farm more of the rewards. So these are just things you guys need to keep in mind. Let's go and hit you guys with a wisdom one-liner. Proverbs chapter 13 verses 20. Walk with the wise and become wise, for a companion of fools suffers harm. Surround yourself with wise people. I hope you guys enjoyed this KuCoin DigiDive on Curve DAO. If you guys enjoyed this video, make sure you guys smash up the like, subscribe to the channel, and tell me what you guys think of Curve. If you want to check out some of our previous videos, you can go here, 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 and like there.